Investing is no longer just a choice. It's a vital tool for building long-term financial security. As the global economy continues to evolve and the cost of living steadily increases, the idea of simply saving money in a bank account is becoming outdated. If you're someone who wants to take control of your financial future but doesn't know where to begin, you're not alone. This guide is tailored for absolute beginners in 2025 who are ready to learn how to invest wisely even if they have limited knowledge or funds to start with. Why should you invest? The most pressing reason to begin investing is to protect your money against inflation. In simple terms, inflation reduces the value of your money over time. What you can buy for $100, 0 cents today, might cost $110, 0 cents or more a year from now. If your money is sitting in a regular savings account that earns very little interest, you're actually losing purchasing power every year. Investing helps you grow your money at a pace that keeps up with or exceeds inflation, ensuring your wealth maintains its value over time. Another reason investing is important is that it helps you build wealth gradually. When you invest, your money has the potential to grow through compounding. This means that not only does your original investment earn returns, but those returns can also generate additional earnings over time. For example, investing just $100, 0 cents a month into an index fund with a 7% average annual return could grow into over $120,000, 0 cents in 30 years. The earlier you begin investing, the more time your money has to grow. Investing also allows you to meet financial goals more efficiently. Whether you want to buy a house, travel the world, save for your child's education, or retire early, your income alone might not be enough. Investing helps bridge the gap between your current savings and your future needs. It makes your money work for you, so you're not just relying on your paycheck. Understanding the basics of investing. At its core, investing is the act of putting your money into financial vehicles like stocks, bonds, mutual funds, real estate, or other assets with the intention of making a profit. The key idea is to use your money to earn more money, either through price appreciation or income such as dividends or interest. There are many different types of investments available in 2025. Stocks represent ownership in a company and can yield high returns, but they also come with a high level of risk. Bonds, on the other hand, are like loans you give to governments or companies. In return, you receive fixed interest over time. While generally safer than stocks, bonds usually offer lower returns. Exchange-traded funds, ETFs, and mutual funds are excellent options for beginners. These are collections of different stocks and bonds bundled together. ETFs can be bought and sold like regular stocks, while mutual funds are managed by professionals who make decisions on your behalf. These pooled investments reduce the risk of losing everything because they're diversified across many assets. Other options include real estate, which involves purchasing property to earn rental income or profits from resale, and cryptocurrencies like Bitcoin or Ethereum. Although cryptocurrency has gained massive popularity, it remains a highly volatile and risky investment option. New platforms in 2025 have also made investing in commodities like gold, silver, or oil easier than ever. It's essential to understand the balance between risk and reward. Generally, the higher the potential return of an investment, the higher the risk of losing money. Knowing this balance helps you make smart, informed choices based on your goals and risk tolerance. Set clear financial goals before investing. Before jumping into the investing world, it's important to understand what you're investing for. Do you want to save for a house in 5 years? Or maybe you're thinking long-term, like planning for retirement. Your financial goals will influence the type of investments you choose, how long you plan to stay invested, and how much risk you can handle. Defining a timeline for your investment goals is equally important. If you need the money within a year or two, for example, to buy a car or fund a wedding, you'll want to stick to safer, more liquid options like high-yield savings accounts or short-term bonds. For medium-term goals, such as saving for a home down payment in 3 to 5 years, you might be comfortable taking on moderate risk by investing in a mix of stocks and bonds. If your goals are long-term, like retiring in 20 years, you can afford to take more risk and invest in higher growth options like stocks or real estate because you have time to recover from any market dips. Build a strong financial foundation first. Before you invest a single dollar, it's important to have your financial house in order. The first step is to eliminate any high-interest debt, such as credit card balances. If you're paying 18% interest on a credit card, that's money draining out of your pocket every month. No investment can reliably match that rate of return, so paying off debt is like getting a guaranteed return on your money. You should also build an emergency fund. Life is unpredictable, and having 3 to 6 months of living expenses saved up can protect you from unexpected events like job loss, medical emergencies, or car repairs. This fund should be kept in a separate, easily accessible account so you're not forced to sell investments during a financial crisis. Another foundational element is understanding your risk tolerance. Some people can handle seeing their investments drop 20% without panicking, while others lose sleep over minor losses. Your personality, income, family obligations, and financial stability all play a role in how much risk you should take. There are online quizzes and tools that can help you figure this out. Choose the right investment accounts. In 2025, there are more options than ever when it comes to where you put your investments. A regular taxable brokerage account is the most straightforward option. It offers flexibility and access to a wide range of investments. However, any profits, capital gains, or dividends you earn are subject to taxes. There are also tax-advantaged accounts specifically designed to help you save for retirement. The most common are traditional IRAs and Roth IRAs. A traditional IRA allows you to invest pre-tax income, reducing your taxable income now, but you'll pay taxes when you withdraw the money in retirement. A Roth IRA, on the other hand, is funded with after-tax dollars, but your withdrawals in retirement are completely tax-free. If you're employed and your company offers a 401k plan, take advantage of it, especially if they offer matching contributions. That's free money. If you're self-employed or freelancing, there are options like SEP IRAs and solo 401ks that offer similar tax benefits. For parents, 529 plans are investment accounts that allow you to save for a child's education while enjoying tax advantages. Custodial accounts are another option if you want to start investing for your child's future in general. Making your first investment. Once your foundation is solid, it's time to make your first investment. The best starting point for beginners is often index funds, or ETFs. These funds track the performance of a market index like the S&P 500, which includes the 500 largest publicly traded companies in the US. Instead of trying to pick the next big stock, you're investing in the overall economy. Over the long term, index funds typically return about 7-10% annually. Another smart strategy is dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. For example, you might invest $200, 0 cents on the first of every month. This removes emotion from investing and reduces the risk of investing all your money just before a market drop. If choosing individual investments sounds overwhelming, robo-advisors can do the work for you. Platforms like Betterment, SoFi, and Wealthfront use algorithms to create and manage your portfolio based on your goals and risk tolerance. They usually charge lower fees than human advisors and are great for hands-off investors. Avoid these common mistakes. One of the biggest mistakes new investors make is chasing quick money. Viral tips on social media or YouTube promising 10x returns overnight can lead you to make irrational decisions. Investing is not gambling. It requires patience, discipline, and a long-term perspective. Another mistake is trying to time the market. Buying low and selling high sounds great in theory, but even professional investors rarely get it right. What really works is staying invested and riding out the ups and downs of the market. Also, pay attention to fees. Some mutual funds or investment platforms charge high management fees, which can eat away at your profits over time. Always compare expense ratios and choose low-cost funds whenever possible. Diversification is another critical principle. Don't put all your money into one stock or one sector. Spread it across different industries, asset classes, and even geographies. That way, if one investment performs poorly, others can balance it out. Consider real estate and alternative investments. Real estate is a time-tested investment option. In 2025, you no longer need to buy a full house to get started. Platforms now allow you to invest in fractional real estate, where you can buy a share of a property for as little as $100, 0 cents. Real estate can provide steady rental income and long-term appreciation. Cryptocurrency continues to be a hot topic. While it's risky and highly volatile, allocating a small portion, no more than 5% of your portfolio, to cryptocurrencies like Bitcoin or Ethereum could offer high returns. However, only invest what you're willing to lose, and always do thorough research. Commodities like gold and silver are often used as a hedge against inflation and economic instability. In 2025, it's easier than ever to invest in these through digital platforms offering gold, ETFs, or fractional gold ownership. Helpful tools and resources. To manage your investments and budget effectively, use modern tools. Investment apps like Robinhood, Fidelity, and Schwab offer commission-free trading and user-friendly interfaces. Budgeting apps like Mint and YNAB help you keep track of expenses and savings goals. There are also excellent learning platforms. Investopedia is a go-to site for financial definitions and advice. YouTube channels by creators like Graham Stephan or Andrei Jikh break down complex investing topics into simple videos. If you enjoy reading, books like The Intelligent Investor and The Psychology of Money are full of timeless wisdom. Grow as an investor over time. Your investing journey doesn't end after you buy your first stock or fund. It's important to review your portfolio at least once a year. Over time, certain investments will grow faster than others, shifting your original allocation. Rebalancing ensures your portfolio stays aligned with your risk tolerance and goals. Automation can also help you stay consistent. Set up automatic transfers from your checking account to your investment accounts. This way, you're investing without even thinking about it. No excuses, no missed months. Finally, stay informed. Follow credible financial news, keep an eye on economic trends, and always be open to learning. Markets are influenced by a wide variety of factors, including interest rates, technology advancements, global conflicts, and policy changes. The more you know, the better equipped you are to make smart decisions. Investing for beginners in 2025 doesn't require a finance degree, a large income, or a perfect plan. It just requires the willingness to start. Every dollar you invest today is a building block for your future wealth. Begin with small steps. Focus on learning, avoid shortcuts and hype, and most importantly, be patient. Time is the most powerful tool in investing. The earlier you begin, the more time your money has to grow. So stop waiting for the perfect moment, because the perfect time to invest is always now. So that's it for today. If you like this video, then please hit the like and subscribe button for more videos. Thanks for watching.